Hello, everybody. This is Jerry Kronenberg, Director of Financial Content here at Moomoo Technologies, Inc., and I'd like to welcome you to our latest Moomoo Markets seminar, where we're talking about how to invest in the markets and how to be a better investor. Joining me now is a very special guest, Jeff Hirsch, Editor-in-Chief of the Stock Traders Almanac. Jeff, hello.
How you doing, Jerry? Good to be with you.
Great to be with you, too. And we're talking about a very special topic for the presidential election year and the recently passed President's Day, and that is the Presidential Election Cycle Indicator. Now, Jeff is Editor-in-Chief, as I mentioned, of the Stock Traders Almanac, which is known as Wall Street's Bible. He's also the author of 2 books about investing. And the Stock Traders Almanac is known for popularizing or discovering a number of theories, such as the so-called Santa Claus rally, the January barometer, the sell in May and go away theory, and the presidential election cycle theory, which talks about the fact that the markets historically do better or worse, as measured by the S&P 500, by where we are in a president's term. And of course, we're in the 4th year of Joe Biden's term. So let's talk about this theory and how it might help you invest. Jeff, welcome. Can you, in a nutshell, explain to us what is the presidential election theory and how does it work and why, in your estimation?
I'm going to give you a little bit of the why first. There's
Sure.
a page that we have in the 2024 Stock Traders Almanac that my father, who started the company back in the 60s, Yale Hirsch, who's no longer with us, he was 98 when he passed in 21. The page, the title, the concept is How the Government Manipulates the Economy to Stay in Power. So basically, you've got a 4-year cycle, and unlike any other nation on the planet, we have a regular election every 4 years on the same day, whereas there's plenty of votes of no confidence and all this parliamentary business that is not what goes on in the USA. So what you have is a president coming in to power and trying to take care of the least savory, difficult policy initiatives in the first couple of years so that they can begin to prep for keeping their party or themselves in office in the 3rd and 4th years. And that's why you have these midterm lows, these midterm bear market bottoms like we had in both the past 2 cycles, the past 2 presidencies, the past 2 terms. And then you've got the 3rd year, the pre-election year, when they're priming the pump, where you have most of the largest gains of the 4-year cycle. Election years, which we're in right now, average gains, around 7, 8, 9%, depending upon the time frame that you're looking at, but better when you've got a sitting president running for re-election.
Which, of course, we do. So that's the theory. And why don't you talk about, so if I understand it correctly, years 1, 2, 3, 4 have historically different successes or failures for the S&P 500. I believe year 3 is typically one of the best, if not the best. Of course, we had a 24% gain last year, 2023, which is an excellent gain.
It was a textbook pre-election year last year.
Excellent. Great. Well, that's good news. Let's talk about this year, and feel free to talk about some of your other theories. I know you look at, again, whether we do or do not get a Santa Claus rally, which we did not.
Sure.
Positive January barometer, which is the S&P 500 going up for January as a whole, which we did. Why don't you talk about those theories and how it fits in and what you're seeing for the S&P 500 for 2024?
Sure. So just to go back a little bit, the 4-year cycle, just to give you the parameter, from 1950 to 2022, you have the post-election year, the year after elected, the first year of the term, up 7.9%. Midterm years, 4.6. This is S&P, by the way. Pre-election year, 3rd year, 16.8 on average. Election year, 7.3%. So in addition to that, one of the things that we talk about is this sweet spot of the 4-year cycle, which I just hit perfectly last cycle. It's the midterm low to the pre-election year high. My father came up with the phrase, midterm years are bottom picker's paradise, back in, and also the October, phobia, the bargain month, the bear killing aspect of it, which was something that was in the 1969 Almanac, going way back. It's still true. There's a whole bunch of reasons for why the seasonal low tends to occur in October. And back in 22, when everyone was all scared because we didn't have enough of a recession or selling and the sentiment wasn't bad enough, I came out and was long October 22. We had a textbook midterm bottom. And then the sweet spot is the 3-quarter combination from Q4 of the midterm year to Q2 of the pre-election year. Average gains about 20% Dow and S&P for the 3 quarters, almost 30 for NASDAQ. Happened to, yeah, we had a little bit weakness at the end of 22 for NAS, but I have a wonderful chart here that I'm just glancing at, where, you know, the 4-year cycle is just firing on all pistons here for the last 4 years. You can see it tracking very closely. Currently, from another October low in 23, yeah, we had a little selling in early January, but now we are just heading up to that Q1 peak. And seasonally, if you look at my sitting president cycle pattern, which is 12.8% average gain for the S&P 500 versus an open field, which is minus 1.5. That's when nobody's running. So anyone that thinks or is expecting Biden to step out, they should probably be either, you know, tightening up their stops, going short, or looking for a little sideways weakness, because you have an average loss of about 1.5% for the full year when when there's an open field, no sitting president.
So go ahead.
Go ahead. No, go ahead.
Oh, no. So just to clarify for folks, when the sitting president is running for re-election, which we currently see with Joe Biden, the market gets about a 12% average gain on the S&P.
Almost 13.
Okay. When there is no sitting president, and some people speculate maybe Biden will not end up running, maybe he'll drop out, that you actually get a small 1%-ish loss on the S&P, I believe.
Now, I kind of use the stock market as an indicator, like a poll almost. Not almost, like a poll. And if you look at the comparison of this year to the sitting president line, it's tracking it quite closely. We're selling off a little bit here, end of February. Very little. We've had a very strong February, which is bullish in and of itself, but the December, January, February, all being up, unless something drastically happens before the month closes. But there's a bit of a downdraft, a seasonal decline in that sitting president line, and it lines up with the sort of beware the Ides of March, the tendency to see some weakness into mid-March, and also, you know, there's the end of first quarter tends to see some selling as portfolios are adjusted with the institutions, and also the week after triple witching is down significantly. There seems to be some selling after that, you know, aligning with the end of Q1. So we're looking for a seasonal dip, nothing negative. I don't think we're going to get more than 5 to 10%, if that, maybe a little bit more. It depends upon what goes on. But, you know, some of the other things that we're looking at, you mentioned the Santa Claus rally, and there's the first 5 days indicator, which we didn't invent, but it's been something we've tracked in the Almanac since the beginning, and the January barometer. Both the Santa Claus rally were invented by Yale Hirsch in 1972. They're in the 73 Almanac. Santa Claus rally gets quoted or misrepresented frequently. Last year, they were talking about it in August and October. It's really a short 7-day trading period. The last 5 days of the year, the first 2 of the new year, that's sort of Christmas to New Year's week, where the markets tend to be quiet. It's the pros on there. You and I are going out with family and friends, and maybe going to, you know, the islands or something for a little getaway. And it's just a small gain, about 1.5% on the S&P. But when it's down, as the phrase Yale coined is, if Santa Claus should fail to call, bears may come to Broad and Wall. Same thing with the first 5 days, early warning indicator. But the full month is what, you know, the January barometer, as the S&P goes in January, so goes the year. So we had negative Santa, negative first 5, and there's only 3 years, I got the little table here, that we had a down Santa Claus rally, down first 5 days, and an up January barometer, 85, 91, 93, average gain 15.1% for the next 11 months, 19.9% for the full year, all 3 up. And in addition to that, people will say, well, the market's up, you know, 70% of the time on average anyway. January barometer doesn't tell you anything. But we did a comparison of the outperformance for the market for the 11 months following and the full year, when January's up versus down, versus the same calculation for all the other months of the year. So the outperformance difference when January's up is 10.4% for the next 11 months. When it's up 11.6. When it's down, the next 11 months are up only 1.2. So there's the difference. For the full year, it's 11.2. All the other months, 5-ish or less. So the significance of the outperformance of January, of a year following up January is important. And then just to drive the point home, when the January barometer is up in an election year, the market is up 100% of the time since 1950. Average gain 15.6%. So that's some of the things I'm looking at. With respect to some of the fundamentals and other work, we're looking at the PCE coming out later this week. We have a calculation that shows the projection. Now, it looks like it's quite optimistic to get to 2% on the PCE chain index, the one that the Fed tracks, because any month-to-month gain of more than 0.1% will keep us above that 2%. That's why we think that we're going to get not get a cut until after mid-year, as it takes some time for this to work out. So GDP is strong. I don't know if that number came out yet, but it was looking like it's going to be above 3 again. So, we're watching the 10-year, and it seems to be in a range. So, there's some technical support levels I have for if we do get that seasonal decline, that correction. But I'll let you jump in and ask me what you want to ask me.
Oh, great. No, I'm going to ask you for your overall view. But before I do, I'm just going to remind folks this is an interactive webinar. So we'd like you to join us, and feel free to use our chat group to ask questions for Jeff. If you submit a completed question, you will get 100 bonus points. If we do use it on air, you'll get another 1,000 for 1,100 altogether. So feel free to submit your questions now. We do have some that we got in the days leading up to this, which we're going to start with. First one is from user M. Treasy. Does the market tend to do better under a Democrat or Republican? And if it does better under a certain party, why is that? Jeff, any thoughts on that one?
Yeah, we have a chart, a bar chart that I show when I in my slide decks when I present, that shows the political alignment market performance. So all the different comparisons, all years, Democratic president, Republican Congress, Democratic Congress, split Congress, all the combinations. It's not necessarily the party of the president that matters for the stock market. It's the party of Congress. The best combination is a Democratic president and a Republican Congress. 16.4% for all years that you had a Democratic president, Republican Congress. Split Congress with a Democratic president like we have right now, 11.7%. So it's kind of counterintuitive, but you think about it, the party that controls the purse strings in the House, not just the House, in the Congress, is what impacts the stock market. And then if you have a Democratic president with some sort of a little more progressive thinking with the conservative thinking Republican Party, and they work together like they used to, like Clinton and Gingrich, even though they had the issues. Reagan and Tip O'Neill did pretty well. But when you have that compromising, that meeting in the middle, especially with a Democratic president trying to be progressive and a Republican Congress trying to hold the purse strings, that seems to be the best combination.
Great. And for those of our viewers who are not in the United States, we have a president can be typically of one party, Democrats or Republicans. We have two houses of Congress. One is called the House of Representatives. One is called the Senate. So when Jeff refers to a split Congress, it means one party holds one house, another party holds the other. But for instance, Republican Congress would be both parties holding, one party holding both houses, I should say. All right, next question comes from Tanken, if I'm pronouncing it correctly. Do the Magnificent Seven have any reason to favor one candidate over another? And how will either party have an impact on the stock market, which we sort of addressed, and to some extent, China and the world? A lot to unpack there. Any thoughts on that, Jeff?
I don't think the party has any impact on the Magnificent Seven. This is a technology boom. This is something that's bigger than the party, bigger than politics. This is, I did a book. I'm going to just sort of jump the script here for a second because it's part of this. I did a book in 2011 called Super Boom, why the Dow can hit 38,820 and how you can profit from it. I first came out with that forecast in May 2010 with the Dow at 10,000. In case you didn't look, we're above that now. My projection was for that number by 2025. We got it early. It's based on a cycle that Yale discovered back in 76, where the market rallies 500% after war and inflation. And the studies that we did found that there's also this is a mouthful here, a culturally enabling, paradigm shifting technology that is part of the super boom equation. I believe that AI is potentially that, like the microprocessor and the PC was back in, the early 80s. So this is bigger than politics. And that kind of technology is something that changes the world collectively, and each one of us, inherently individually, which things like the computer did. Look at what we're doing here with the video conference here. So I don't think it matters who's in power for the Magnificent Seven, though there is some rotation potential. I've got some other types of picks out there. I'm in the queues myself. Our seasonal best 6 month switching strategy, which you sort of alluded to, not sell in May. People say sell in May and go away. I like to say buy in October and get your portfolio sober, just as a little cheeky. But China, I don't like to get into politics too much because people have feelings, and I'm a cycles guy. There's definitely, a difference of opinion on how to handle China. I think China's got their own troubles. I think people know from the last president's term how they're going to deal with China and the current president's term. I personally think we should be engaging and being more, aggressive on all fronts. We should be around the world developing things as the USA with resources in other parts of the country. I also like the fact that we're doing more internally with, industrial activity and that sort of thing. So the rest of the world, just like the US, is going to be very happy once the election is over and we have a decision. So right now, the reason why the sitting president pattern is better than the open field is because the market hates uncertainty. And if the likelihood or the possibility that we've got the same policy initiatives, economically, civically, socially going forward, then the market knows where to lay its bets. But if you have an unpopular president, which some might say we do, when that unpopular president gets ousted in November, there's sort of something I call a ding dong, the witch is dead effect, a little shout out to the Wizard of Oz, where the market rallies stronger when the party changes power, if you've got that going on there. So either way, the market rallies after the election because we know there's the removal of uncertainty. We have a decision. So that's sort of the general impact. And I mentioned our outlook for the year is quite bullish, 8 to 15%, but we look for some weakness ahead of the conventions in what is the sell-in-May period, the worst 6 months, Q2, Q3. If you look at some of the seasonal charts that I put out there, you can see that there. So if those didn't get in, like we did back in October for our annual trade, look for some weakness coming up here, maybe even at that sort of mid-March, end of March period. Looks like there's frequently a low point of buying opportunity there.
Well, that's great. We're going to take a live question here from Dada Kai, if I'm pronouncing it correctly. Hi, Jerry and Jeffrey. What can a long-term value investor do differently during this period? So you've got a lot of thoughts about things. This is a long-term, again, value person. Any thoughts for that?
Long-term value or growth, it's long-term. You want to be looking at the 4-year cycle, that sweet spot I mentioned at the beginning. You want to be looking to add to positions during the weak months, August through October, and staying long through these cycles, and also getting in at that midterm low like we had in 18 and 22. So sometimes, there's also the switching strategy that we do every year, where you basically buy in October. We use our MACD technical trigger over there, but there's also a strategy where we overlay the 4-year cycle with the best 6 months, and you only buy and sell during the post-election year, and there's a page on this in the Almanac, and the midterm year, and then you basically from the midterm low through midterm October through the post-election year, April, May, you're just staying in there, and then you trade in and out for the 6 months over that year. There's some fees involved there, perhaps trading fees, commissions, but you do it in a retirement account. That's taken care of.
Great. And next one, again, getting into different parties holding things. I think you've addressed this, but we'll check it out anyway. Young Wen is saying, how does market do in history when both the presidency and the Congress is controlled by Republicans? Of course, we got that in the 2017 period during Trump's first time in office. Any thoughts on that, Jeff?
I have an average gain of 13% for the Dow. So not horrible, but you're getting that boost from a fiscally conservative, purse string controlling Congress. So nothing negative there.
Okay, we'll see what happens there.
Combination.
Great. Next one is from how. Oh, go ahead, please.
No, go ahead.
Oh, please. Next one is from Howdy High, if I'm pronouncing it correctly. If Trump wins, will the stock market react as it did when he won in 2016? Now, as a reminder, the market did quite well when it became clear he was going to become president, going up 6.5% on the S&P in the 2.5 months between the day before the election day and the inauguration, 2.5 months later. And then in his first roughly year, from the day before the election day till January of 2018, when it peaked, we got a 42.8% rally in about 13.5 months. A pretty good performance.
And his post-election year was strong too.
Yes. Any thoughts about that? Of course, Trump may win, he may lose. We don't know. Mm-hmm.
I would expect a similar type of reaction, but less magnified because it's the second time around, and everyone was sort of betting on something new happening and changing and draining the swamp. And now we've all seen what the reality of a Trump presidency is. I'm not going to get into the personalities and ideologies of it, but the fact is that people now know versus not knowing, and I think that I would think that would soften that positive reaction. As I said, probably be a rally and some ding dong the witch is dead, but I don't think it will be as strong because we've been there before. Just like the sell off. When we had the, government shutdown threats there, wasn't as bad as it was back in 2011 when everyone wasn't, familiar with it. So probably softer now that we know. Go ahead.
Great. Next one, interesting one. Do you think interest rates will come down before or after the election results? A lot of speculation. Would the Fed cut rates to help the incumbent president? Will they not? Will they not? Because they don't want to look political. Any take on that?
My current feeling is that they won't do any cuts until after mid-year based upon the PCE inflation. We'll get some more visibility on that coming up. And I don't suspect more than 2 or 3 for the year. There was a lot of talk about 6 or 7. So I'm looking at maybe 75 basis points for the year. They might cut a little bit, but they're not. I just read a piece about Waller in the Journal this morning that they are really being prudent, patient, data dependent. We all are. I'm data dependent. But if the inflation doesn't come down to 2%, and if anything changes with the JOLTS number, especially the vacancies, they won't, that's kind of what they're looking at to cut. So, it's still pretty 50-50 for July. Last I checked the CME futures, but maybe they'll take a quarter or 2 off. Pretty sure Powell wants to get reconfirmed, and I don't think Trump's going to do that. So you never know what's what the calculus is there.
Interesting. Good stuff. I'm going to take the last question. So add it all up. We've talked about a lot. I think you did mention this, but let's reiterate. What's Jeff Hirsch's overall S&P 500 projection with whatever specificity you want to give us for 2024?
Yeah, I don't have a target number. Okay. We use percentages. Our base case scenario is 8 to 15%. That's kind of Dow, the granddaddy of them all, and then probably a bit more for S&P and NASDAQ, especially with this AI, chip tech boom. So bullish. I look for some weakness during the week 6 months. Q2, Q3, May through October. And other than that, once we get a decision on the candidates for the conventions, last 7 months of election years are up, only down twice in 2000 and 2008 when we had the undecided election and the great financial crisis. So I'm bullish.
Okay, we'll leave it there. Thank you so much. Great conversation as always. Thanks everyone for tuning in. I'm Jerry Kronenberg from Moomoo Technologies, Inc. Check us out on the web or on our app 24/7 for Great information about investing. Jeff, thanks.
Thank you, Jeffrey.
Editor-in-chief of the Stock Traders Almanac. Thank you, everybody, for watching. Have a great trading day. Take care.